Welcome everyone to Founders Q&A with Anthony Millin. We're excited to have everybody here today. Anthony is the founder of Next, a serial entrepreneur, venture capital partner, and startup attorney. Feel free to put your questions in the chat as we go along, and just to note, we are recording this session. And with that, I'll turn it over to Anthony.
Great. Well, thank you, Lisa. It's great to be here with everybody today. Just briefly on Next. Next is an innovative new model for delivering legal services to startup and emerging growth companies for their full life cycle of growth. We offer predictable legal fees through fixed price packages and service bundles. We have access to seasoned senior attorneys through a very hands-on, high-touch delivery approach. And we integrate a robust technology platform to make the delivery of services much more collaborative, much more transparent, and much more efficient. And for more information, you can always see more about what we're doing at www.next.law. So with that, very happy to hand it over and see kind of what questions people have. As we said, it's kind of a very informal type of setting where we're happy to cover kind of a broad range of questions that may come up.
Tom, if you'd like to go first, I know we were starting to talk about your question. Feel free to jump in.
Sure. Okay. Well, I'll go ahead and ask it, but I'll also put it in the chat so there's so that you also have it on screen. So I'm kind of curious. I've looked at all the well, somehow it doesn't paste. Anyways, I'm kind of curious. I've looked at the Y Combinator stuff, and obviously everyone says start a C corp. And we have a unique situation. We have to take another entity before we do the C corp. But starting out from the C corp position with two co-founders, and I understand that to keep everybody on board, both investors and the founders, that those should vest over time, 3 to 4 years. Do the founders have to buy their initial shares, or how are they distributed to the founders?
Yeah, so typically when you first set up a new company, before it's really starting to do business and starting to build up a lot of value, you're able to issue founder shares that often get issued at the par value of the company, which usually when you set up a new C Corp, you might set it up with just say 10 million shares authorized to be issued and a par value of 0.00001, so a very low par value. So while you are subscribing to your initial founder shares, it's a very small dollar amount, sometimes $10, sometimes $100 that you're talking about. It is important for those shares to vest. And the reason it's important for those shares to vest is, number one, investors want to see that the founders are committed and tied to the company and earning their shares over time, because as a investor, you're basically in the early stages, what you're most investing in is the team. You're investing in the idea in that it's a big market opportunity, but ideas can change, companies pivot, markets change slightly, but so the team is the core, and you want to make sure that team is there for the building of the company. The second reason why it's important to have vesting shares is when you have multiple founders. Let's just say you have 3 founders who all each start off owning a third of the company. And one of those founders leaves early after 6 months or 12 months. Sometimes it's because of disagreements between the founders on vision and strategy and approach. Sometimes it's just life. Something happens in one of the founders' personal lives that requires them to leave. And if they leave and you don't have vesting, then they leave with a third of the company, and the other founders are left spending the next 5 to 7 years building a company with one person leaving with a third. So that's kind of how it works with the C Corp, with the founder shares, and why vesting, which you mentioned at the beginning, is important.
Okay. So as I understand it, then it'd be before any value is put into the C Corp, that it's a nominal amount of money the founders pay into the business. And thereafter, what happens when, let's say, the C Corp. So I see there's a different package for starting a C Corp from scratch and then converting an LLC to a C Corp. And I've seen that I've heard from Y Combinator, there's some horror stories in some cases because the way some LLCs are formed when they try to become a C Corp. What's the difference if you're going to go ahead and start a C Corp from scratch and then say acquire an LLC?
Well, you wouldn't, the way if you were going to move to a C Corp from an LLC, you would in essence convert the LLC to a C Corp. So you wouldn't set up a new LLC and then a new C Corp and then acquire your LLC. You actually convert the legal entity, and you can not only convert from LLC to C Corp, but if you're based in Maryland, you could also move at the same time to Delaware, since investors like entities to be Delaware entities. So you end up at the end of the day with being in a C Corp. It's just the pathway there is different. And the more complex your LLC cap table is, the more complex your conversion is. So sometimes, depending on how you set things up in the LLC, can have some impact on the conversion in terms of what's involved, but both put you in the position of ending up with the C Corp.
So what if one of the co-founders of the C Corp aren't a member of the LLC? Should they become a member of the LLC
the
first?
C Corp converts. So you take all the owners, what you want to do is before the conversion, everyone who's in the LLC becomes immediately upon conversion shareholders in the C Corp. So anyone who was a member owning a membership interest in the LLC, based on a conversion ratio, ends up with a certain number of shares in the C Corp.
Okay, thank you.
Sure.
Thanks for the questions. Robert has a question, Anthony. What are your thoughts for entrepreneurs in the current economic climate?
So, what's interesting, we're still seeing a lot of activity in the investment community. There are significant funds amount of capital that VC funds and institutional investors have raised in recent years, and they have to deploy that capital. And so we're still seeing a lot of activity in terms of capital being raised, particularly from institutional investors. We are seeing and hearing about the valuations, which have been extremely high. And we are seeing some, and expect, while institutional investments will still continue at a healthy pace, that some of the valuation highs that we've seen in recent years may normalize a little bit more. In terms of the really early angel investing, that tends to correlate more with the economic climate in terms of, if people's 401k plans and stock portfolios are all doing very well, they feel more comfortable allocating some of their personal dollars to alternative investments like startup companies. They're not sitting on a pool of capital that needs to be deployed the way an institutional investor would. So that is kind of my thoughts, is you may, if the economy starts slowing down and stocks start dropping and people's portfolios, you may see a change in both valuation and amount of deals being done on the angel side. On the institutional side, you'll still see a number of deals being done, but maybe at different valuations.
Terrific. And Andrea has a question. What are some ways to offer investment opportunities without offering shares in your company? Maybe clarify that if you're unsure.
Yeah, in essence, when you're raising money, you're either selling equity in your company to investors, and that could be done as a straight equity investment, for instance, in preferred stock. You can raise money in terms of safes and convertible notes, which convert into equity. So you're not giving up, those will become equity at some point down the road when there is a conversion trigger. You're raising money in pure debt, but it's very challenging, right, to raise money as an early stage startup company who maybe does not have a lot of revenue and profits yet, to go to a bank and raise debt, which is not equity. And then there's grants. So looking for non-dilutive funding from different organizations, whether they're government organizations or nonprofits or other types of organizations that issue grants. But those are kind of, you're either selling equity, you're issuing debt, or you have non-dilutive funding coming in the form of a grant, are kind of the most common ways that you see money coming into a company. It's not, there are not too many avenues unless money comes in and you have a right to buy it back down the road. I mean, investment comes in that you can redeem, but why would the investors take the early risk and have a redemption clause in there? So it's challenging to raise money and not have some impact on your cap table unless it's a grant.
Andrea, hopefully that answered your question. Tom has a follow-up. What should co-founders pay themselves? Market rate, minimum wage, living wage? What are your thoughts on how that looks for investors and what companies should do?
I mean, with respect to founders, part of it depends also on the size of your raise. So, you may see founders who pay themselves early on 60 to 80, as an example, just say 60 to 80,000, depending on how much they've raised, or up to $120,000. I've seen some founders who are doing slightly larger raises. As you get further along, or if you're doing a much larger raise, I'm seeing founders sometimes get up to 180. But you've got to understand that it's got to be commensurate with the size. So if you raise $500,000 in a convertible note, or 750, or even $1 million, and you're trying to take 20% of that out as a salary, or if you've got two founders, 40%, the investors really are looking for their capital until there is some proof of concept and some traction, and particularly some revenue, to be below market. So in your question of minimum, no one wants a stressed founder, and no one wants somebody who's so worried about their day-to-day lives that they can't focus on the business. So I don't think it needs to be at that point. People want you to be able to focus on the business and be in a position, but it's going to be below market in terms of what you would get in a larger company as a market salary, because your big upside is through your founder's stock. So you always look to the size of the raise, how many founders are taking out salary. You have a conversation with your early investors to make sure everybody's on board and comfortable, and then look for kind of the lowest amount that doesn't put you under tremendous strain to the point of being a distraction.
Excellent. Josh was asking about Cardo and if we use Cardo, which of course I said that we do, but what are our thoughts if you want to sort of do a little plug to why we've chosen Cardo as our partner?
Yeah, so we work very closely with Cardo. We've been working with them for many years now. Like Lisa said, we're a partner of Cardo. We believe that having a cap table on a platform like Cardo is very important as you're building and scaling a company. It's very helpful for investors who have access to different views of the cap table. It's particularly important as you start having stock options with vesting, to be able to track stock options with their start dates and their vesting dates. So we find it to be a very helpful and important platform, and one that investors now are kind of looking for companies to not just be managing their cap table in Excel, but managing in an online platform. And Cardo is a very scalable, strong solution with tens of thousands of companies now that are on it. And I think that makes it a leader in the marketplace.
Terrific. Robert has a follow-up question, it seems, from earlier. In a future downturn, since valuations are currently so high, when is a good time, or is it a good time for operators or entrepreneurs to look towards and execute on an acquisition strategy, assuming if they have the capital means to do so?
Yeah, I mean, I think as high as the market is right now, valuation-wise for VC and VC investing, equity investing, I think companies are experiencing something similar in terms of how high the valuations have been on the M&A side, for strong executing, high-performing companies. I think, in any downturn market, if you're sitting in a strong cash position, downturns are kind of good time to look to acquire at lower valuations and multiples. And sometimes people also believe downturns are a good time to start new companies and kind of get things up and running and be ready to ride kind of the next momentum waves forward as you're clicking with the marketplace. So yes, I do think that in downturns, you see a lot of people who are in a strong cash position looking to take advantage of being strong in cash while other people are down in valuation as a time to acquire.
Terrific. Hopefully that answered your question, Robert. No more questions in the chat at the moment. If anybody would like to, we have one for Tom. Thank you, Tom. What is the investment market environment for cybersecurity tech?
In terms of the cyber market, the biotech market, we're seeing a lot of activity in technology across the board. In this particular region, cyber is very, very active in the DC region. There's some great platforms and venture studios and accelerators that focus on cyber. And so, I think across the board, in terms of at least what we're seeing active markets for technology generally, and cyber, and in this region, cyber and biotech being active.
We have about 10 minutes left. Does anybody have a new question or even a follow-up question you'd like to dig into a little bit more? We can do that with this fantastic small group. Thomas asks, can you compare $1 million safe round with accredited investors followed by $1 million Series A?
So $1 million for a safe round falls within what you would see. I mean, we're seeing larger and larger safes. So where safes used to be several years ago reserved for smaller financings, we're seeing institutional investors doing safes, and we're seeing several $1 million being done through safes. So in terms of a Series A round, if someone was looking to raise 1 to 2 million, you may still do that through a convertible note or a safe or a Series C preferred round. Those at a $2 million raise, that we're often seeing that on the seed investments, whether they're priced or convertible notes or a safe. We're seeing for Series A's larger raises once you get to Series A. One of the things that's happened is that Series A investors expect companies to be further along and raising larger rounds than used to than they used to for Series A. So everyone's kind of moving to the right of the curve, where you're seeing Series A's get bigger and later in terms of when people are doing it. And you're starting to see people do multiple rounds in terms of seed rounds. So you may do a safe or convertible note, like a Series 1 convertible note, and then you're not quite ready for your large Series A, so you do a Series 2 convertible note, and your first one is $1 million and your second one is $3 million in the convertible note. And then only after that do you start looking towards doing a larger Series A. So that is what, you know, we're typically seeing is if you're doing 1 to 2 million, that's often now being done in seed size rounds and not in Series A's, which are a little bit further along.
Terrific. Any thoughts on the crypto markets currently or over the next few years?
You know, I don't have any, you know, in terms of kind of market insights on the crypto market, other than, you know, seeing what everybody else is seeing in terms of a large number of people entering the markets and entering blockchain markets and entering NFT markets. You know, we're seeing from an attorney's perspective, the number of businesses and the number of times people are contacting us for guidance on those types of businesses is increasing. So, you know, we don't go a week without a new client looking at Web3 types of applications or NFT applications or crypto or blockchain, and the pace and the growth in how often we're getting requests and seeing people starting companies in those areas is growing.
Awesome. Thank you. Josh has 2 questions. What is the best city or region, perhaps, for raising capital for a hardware or robotics startup? And then what kind of revenue multiple is common for valuations of hardware startups?
Yeah, so on the cities and the valuation specifically to hardware, you know, that's probably not something that I'm best geared to answer. I mean, I think that the markets that, you know, we ask, one thing I'll say is there are more companies than there used to be focused on hardware-driven startups than there used to be. It used to be very hard to find people who would invest in startup companies that were building or making things and had inventory and had hardware. But we, you know, it's something in terms of the fund that I'm a venture partner in and affiliated with has been, was from very early, given their focus on climate, and was very focused on hardware-driven companies. And that was a unique positioning, particularly in the early seed stage investing, having a VC fund specifically focused on doing hardware investing. We are seeing also on the investing side a lot of growth in what I would call earlier stage credit funds, where if you're making things and generating revenue and having some assets, we're seeing even earlier than venture debt, like a Silicon Valley bank or type of bank, or that had been an early leader in venture debt. They were even earlier stage than being able to go to traditional venture debt. We're seeing some funds that were traditionally seed stage equity funds. We're starting to see kind of growth in early stage debt oriented investing that invests along with the equity in hardware oriented businesses and businesses that make things.
And Robert noted that patent and third-party asset valuation is critical, especially for pre-revenue companies, which is very true. Well, we have about a couple minutes left. If there is a final question, I'm also putting in the chat ways for folks to stay up to date with all of the next events. Following us on LinkedIn is a great way. Checking out our events page, signing up for our alert. Any final questions? We have a few minutes left. Feel free to unmute yourself or add to the chat. Well, we are thrilled that everybody were able to attend today. Really grateful. As mentioned, we have lots of events coming up, including on Monday. We have a partner webinar on 409A valuations. Love to have you there. It looks like we have one final question. Are domestic institutional investors still risk averse internationally?
And just in terms of my own experience on the investment side, I think different funds have different focuses in terms of international investing. So if you're doing something that has a global aspect to it, there are funds and institutional investors who are specifically focused on global markets and specifically regional markets. So you may have investors who are specifically focused on institutional investors in investing in Africa or Asia. And so I think what's really important is you will find that there are investors that cut across the globe, and whatever region you're looking at, you should be focused on finding funds that are aligned, and their sweet spot is global investing in regions that you're building your company in.
Terrific. Well, thank you all. I've put some links in the chat again to join us and follow us. We really appreciate you being here on a Friday, a sunny Friday. Hopefully the weather is finally getting a little warmer. And we wish you all a fantastic weekend. Thank you so much. And of course, thank you to Anthony for taking the time to answer all these terrific questions.
Thank you, everyone, for joining us today.
Thank you.
Thank you.